All right, guys, welcome back to the Independent Investor Channel. We're certainly striking at the core of investing when we're really looking to break down this information for new investors. In this video, I'm going to walk you through what I feel are the critical 3 phases of investing. We're really going to try to earmark the characteristics of each phase, and this is really going to help a lot of investors break down the psychological barriers that exist with investing all the time. Usually people just go at this like a blank landscape, and it can be confusing, it can be overwhelming. Maybe laying some of those expected outcomes of some of these phases and some of these roadblocks that you're going to come across may help you anticipate those rather than fear them, and it'll help you understand how to get across or around or under some of those obstacles that you're absolutely going to reach. It's inevitable, guys, and I really think we're helping the majority of investors when they can sit across from the message like this and hear somebody like myself who's been through a lot of those trials and tribulations through my investing career. Guys, if it's your first time to the channel, man, you want to hit the subscribe button, help us support the message that we're putting through. Let's jump right into it. Phase 1 is one of those phases that I feel like folks can get in and out of fairly quickly, okay? This is from going from a non-investor to an investor. And so what I consider in phase 1 is the starting, okay? The inception, the beginning of the process, okay? It's that you've heard enough about investing and you want to understand more about it. What are some of those things that I feel like you need to complete to move out of phase 1 and successfully go from a non-investor to an investor? This is where we start to introduce some of the terminology to you. This is where you start to educate yourself up on the topic and the prospects of investing. A lot of different tools that we throw out there for a beginning investor, very easy to understand concepts of compounding interest, that of which we've covered on the channel, rule of 72, interest rate, what is a stock, what is a dividend, what constitutes fitness with regard to elimination of debt to make sure that you're even eligible to enter into phase 1. Now, phase 1 is one of those that I contend a lot of folks will get into, and there's a high probability of success of a lot of people successfully negotiating through phase 1, okay? So what are some of the things that you're going to complete in phase 1 when you're looking to go from a non-investor to an actual investor and introduce yourself to a much broader world in what investing has to offer? And I think some of those first things, I threw out education to start. Maybe you want to read a few books. You can find all kinds of the best book recommendations in the comments section of my video or the description. I leave the links to some of my favorites. I know a lot of the YouTube community has their favorites as well. The Intelligent Investor, Rich Dad, Poor Dad, etc. And then I've got a few that have really influenced me. The Blueprint for America is one of my favorites, and nobody ever talks about it. Gives away one of the biggest secrets at the end of the book, one that I deploy as a core strategy for me in my investing strategy, but at least to educate yourself up enough to ask yourself the rhetorical questions. How do I start? What are some of the account platforms that we should be looking at? And somewhere in this phase 1, you should be going through the deliberation in respect to your budget on how much you're going to be looking to fund this account. This is where we come out with the videos. A starting amount of $1,000 or $500. Maybe you want to just start the account and look to fund that from zero. You can do that. These are the deliberations that you're going to go through in phase 1. And quite honestly, an investor looking to go from a non-investor to an investor can probably proceed through phase 1. I'll give a realistic time frame of 14 days. Honestly, it shouldn't take you that long. I think if you were really on it in the back and forth of starting the account, getting it funded, and getting all the settings correct in phase 1, I think you could do it much sooner than that. But phase 1 is exciting because if you've got somebody like me saying, look, you can go as a non-investor to an investor by just earmarking some of these things that you're going to have to get answered, some of these questions that you're going to have to get answered, doing a little bit of research. We really try to streamline the research necessary in throwing out some of our favorite brokerage accounts, and that's going to answer one of the biggest questions that I get is what account should I go with, Ryan? We throw out ideas of the self-directed Roth IRA account. And even though you may not have all the justifications you may need to do that, the reason why we throw those out there is from an awareness perspective, and it will also help you circumvent a lot of confusion in that if you just trip and fall into an account that's going to allow you to grow your wealth over time, tax exempt when you reach 59 and a half, that's a huge plus for a lot of investors. And it's something that you'll understand along the line anyway. But in phase one, you've got the ability to get started right away. And you're not going to have a deep understanding of everything, why you're doing what you're doing. And that's why we look to streamline some of those recommendations for you and answering some of these questions. And then it comes down to funding the account. Funding the account is going to be either with your starting amount, or it's going to be your ability to get the account started and initiate the dollar cost average program. Now, a lot of new investors may not understand what this is. That's why I earmark it in phase one as being one of those things that needs to be commonplace in the discussion when you're starting to talk the lingo a little bit. Dollar cost average is the very simple phenomenon of taking a little bit of money, a little bit of capital every single month and injecting it into your account. In other words, it's paying yourself first. It's finding that little bit of money in your budget that you can pay yourself first, right? Intercept that money from yourself and get that channeled into a nice retirement account for yourself. It's amazing, guys, how many people do not do this. And that's why when we strike at the core of fundamental investing, this is where it's made, right here in the trenches. All right, this is where it's made. And a lot of people get really confused as to how some of these things can be started or what the impact can be down the line as we start to enter into some of these other phases. The other thing that you can do once you get the account funded up and you have the DCA set, if you speak it with your spouse or you're a single investor, maybe you earmark $25 out of your paycheck, whatever it is. When you start in phase one, I always encourage a starting amount of $25 because that'll allow you to get that psychological barrier out of the way going from $0 to $25. That can be one of the scariest propositions for a new investor because what new investors tend to do is think of all the things that they're missing out on by opting for paying themselves first into an account that they can't just realize instant gratification for. And that line of thinking is different for a lot of people. And this is one of the biggest critical aspects of phase one. And I think a lot of people do get that. I really do. I think when people enter into phase one, I think a lot of people have a very, very high success rate of getting to phase two. Now, before we can do that, the funding that we do in phase one of the account, we need to look to establish some level of investment posture, okay? And this is the aspect of the equation that I think people opt to focus on right away. What is the right ETF? What is the magic stock for me to buy? And I just spent a few minutes talking about all the other things that you should be focusing on before you get to that last aspect of phase one, and that is the actual investment, okay? To go from a non-investor to an actual investor, you have to be able to enter into at least one product in phase one. And we make this very, very simple because for a lot of people, entering into a product that allows you that diversification right up front is key, okay? Because there's going to be a lot of evolving going on in phase two in keeping your money in the market and watching it fluctuate up and down over time, still keeping your initial programs in place through your dollar cost average and your dividend reinvestment program. But you want to make sure that you're selecting an investment asset that can go into that account that's going to allow you to succeed in the future, that's going to allow you to evolve as an investor. And you're going to toughen up over time. You really are. But one of the big errors that I see with new investors is they go way too aggressive to start. and they don't give themselves a fighting chance, and that can really come back to bite you. And it'll come back to bite you when you least expect it, somewhere down the line in phase two. All right? So that's phase one in a nutshell. The ability to earmark a few educational aspects, some terms, finding that account, funding the account, and establishing some general rules of engagement within that account to start that churn for yourself, okay? This is not the time where you want to be looking at this account and expecting overnight results, okay? Make no mistake, this is about going from a non-investor to an investor, okay? Phase one probably takes the least amount of time to successfully get through, negotiate the steps that I've outlined, and move on to phase two. Phase two is so much different than phase one. Here it is. Phase two is actually where I am currently, and I've actually been there for going on probably, a couple decades at least, okay? I was able to transfer through phase one very, very earlier on in my life. Now, did I successfully execute phase one? In my opinion, no, I didn't. All the steps that I've just outlined for you guys will ensure that you circumvent a lot of landmines in the industry. There's going to be a lot of mistakes that are going to be potential. And if you're not careful, you're going to subject yourself to one or many of those mistakes. And the reason why I outline phase one as being such an important phase, it's really that foundational aspect that's going to set you up and be able to handle everything that you put on top of that foundation as you grow your phases and getting to where we're ultimately aiming to go. All right. Phase two is one of those that's going to be a multi-year process. It's not going to be something to where you're just going to dip into phase one and move right on to phase three. Okay. I'm not even there yet. And I've been in phase two for many, many years. This is going to be where the portfolio is kind of call phase two no man's land a little bit, because this is where folks will get that money established. They'll work really, really hard in phase one, and then there's nothing to do. And it's like, what do I do, Ryan? The account isn't growing. What's going on? I'm not getting results. I'm getting a couple % a year. I may be going through years where I'm down. And it's that instant gratification that you expect, but not understanding that those are fairly unrealistic expectations when you signed up for this gig, okay? Becoming an investor is absolutely an evolution. And phase two, which I consider the monitoring phase, is something that can drive a lot of investors up the freaking wall. It really can. It can drive you mad, because this is the aspect of the investing game where I contend that you can get your portfolio set on kind of an autopilot program a little bit. From a monitoring perspective, you don't need to look at your account every day. You don't. Sometimes it can actually be one of the worst things you can do, because it can subject yourself to emotional decisions that may kind of take over in phase two, and it may allow for moves that are premature in the account. And what we want to do is we want to allow the positions that we've established in phase one and we've taken into phase two to continually work for us and gradually improve over time, but also look to strategically build upon those existing positions or add new positions too. This is the builder's mentality that I'm talking about. Now remember, we are building on top of the firm foundation that we've already built and established, okay? But that does not prohibit you from increasing your dollar cost average program. It doesn't prohibit you from adding other dividend paying assets. Maybe you want to add a few single stocks in phase two of the evolution, and you go ahead and do that. You set those up for a dividend reinvestment program. Maybe you want to introduce a little bit of bond exposure during phase 2. You're free to do that. That's the builder's aspect of phase 2. And it's super important to understand that you will not circumvent this phase. You will not go around it. You will not be able to discard or discredit this phase. This is the most critical phase, and this is where investors are made, and this is where investors are lost. I would say that phase 2 is probably the arena where during the battle we're going to lose the most amount of investors during phase 2, and they will never ever be able to render the benefits that are available in phase 3. So we want to evolve and we want to expand our asset bucket in phase 2. We're expanding our bucket. Now, in any of those situations, did I talk about taking my investments to pay my car payment? Did I talk about taking from my retirement to pay my house payment? This is critical. In phase 2 and in phase 1, you can really look to protect or buffer your phase 2 evolution by always having that cash buffer on the side. There's so much better of a reason, and I know people are going to say, well, you're losing out to inflation. Yes, that may be true, but you're protecting your retirement account. To protect and to buffer, if you have every dime that you've ever earned in your investment account, it really sets you up for those life events, whether it be medical, whether it be automotive, whether it be any unforeseen charge-off that can come in your life, and you may not have a few $100s in the bank account. I really contend you should have a lot more than that. I know the rule of thumb is 6 months. I have way more than 6 months in my accessible cash. It's just one of those golden rules that if you can hear me out, it's so important to strive toward that goal. It can allow you to expand your base and protect it and allow it to start to self-fund itself. This is the frustrating part about phase 2, is that you'll focus in on your account every now and then, and if you do it frequently like I do, it doesn't appear as if it moves very much, okay? And this can be really, really disheartening for a lot of people because time is marching on, okay? We're all getting older, and you think, man, am I on track? Am I on track? And the important part is to stay grounded and really evolve and build your program, not to seek out that short-term validation, but for the prospects of those investments paying off down the line, okay? Another critical aspect about phase 2 that you guys are going to have to embrace, and you need to embrace this key takeaway, and that is to increase your fitness. This is where you become tough. This is where you become an investor. This is where you can handle volatility. This is where you have a ton of green days under your belt, and you've got a ton of losses under your belt, and you've seen your money fluctuate, and you've gone through periods of volatility. It should not make you weaker. It should absolutely make you stronger in your application to set yourself up for entering into phase 3. And I contend that I'm on track. I will be in phase 3, okay? I'm not there yet. I'm not there. Because in phase 3, what I consider is the realization phase, okay? We're not investing to invest. We're not investing to have fun. We're not investing for any other reason other than the fact that it is the responsible thing to do, okay? In whatever degree you choose. I'm not saying that you eat out of a can every single night because every dollar you have is levered to the stock market. But I contend that there's a lot of people out there who could invest, but they don't because they don't think that they can, or they don't understand the phase-in approach that I'm discussing. And in the realization phase, this is where it pays off. This is where all the hard work and all the evolution as an investor is realized. It is critical to understand that in the realization phase, you should be sitting on a group of assets that will allow you to look at your assets and continue to protect those assets into the future. And this is where you have the potential to withdraw those fundings in that account to allow yourself to either fully fund your retirement or supplement your retirement account when you enter into this retirement phase of your life. The retirement phase of your life is X number of years, okay? The idea is that we get there as quickly as we can, but understanding that progressing through these phases cannot be done without the prior. It can't. It doesn't work that way. And some of these phases, especially phase 2, can take a long, long time, okay? A beginning investor who never enters into phase 1 will remain in phase 1 for their entire life, okay? They will have never understood the deliberation of going through all the ups and the downs, the trials and the tribulations, learning what works, learning what doesn't work. This is the in the trenches work in phase 2 that is so beneficial. And if we're educating our subscriber base in the right manner, they're saying bring it on. They're saying bring it on. Bring on phase 2, Ryan. I'm ready. I'm ready to fight with you, and I'm ready to grow and accumulate wealth that you're talking about to eventually step into the phase 3. And the last thing I will mention about phase 3, something super important that I put out there. People ask me all the time, what is my ultimate goal? Well, my ultimate goal is philanthropy. If we have 40 million people in this country that can't feed themselves from day to day. And here we are talking about a luxurious activity for our own personal empowerment. And this is very, very powerful stuff. And if you ever realize that end in phase 3, I wouldn't be doing what it is that I want to do by pushing out a message to say that it needs to remain an individual motive over the course of time. The give back is super important, whether it be through philanthropy or whether it be establishing generational wealth going forward for your family. Guys, if you enjoyed this video, the breakdown of the phases of investing, hit the subscribe button for me, man. Leave your comments at the bottom of the video and share the video with anybody out there that you know needs some basic preliminary entry-level information on the stock market. This is where the Independent Investor channel really strikes at the core of making people think about their own application and how to apply the information correctly. Guys, thank you so much for tuning into the video, and good luck in your investment future.